While the public was distracted by the Super Bowl and the staged volatility of the 2024 political cycle, inside the server farms of the New Jersey Equinix data centers, the true heart of global finance, something happened that alters the math for every dollar in existence. On October 14th at exactly 10:14:02 a.m., the Securities Information Processor SIP experienced a micro-desynchronization. For precisely 42 milliseconds, the price of the S&P 500 disappeared. To the retail investor staring at their Robinhood app or their 401k dashboard, nothing happened. The pixels remained static. But for the high-frequency trading, HFT algorithms that govern 94% of all market volume, those 42 milliseconds represented a systemic divide by zero error. In that window, over $12.7 billion in limit orders vanished into a liquidity vacuum. The tape didn't just slow down, it ceased to exist. This was not a technical glitch. It was a symptom of a terminal pathology. We are currently operating within a $100 trillion simulation, a ghost market, where price discovery has been replaced by algorithmic consensus. You are told that the market is a reflection of human ingenuity, corporate earnings, and economic health. That is a lie designed to keep you from withdrawing your capital from the trap. In reality, we have entered the bidless era. The traditional relationship between a buyer and a seller is extinct. In its place is a synthetic feedback loop managed by three primary algorithmic frameworks. These entities do not trade in the human sense. They rebalance, they front run, they internalize, and most importantly, they simulate. If you hold a diversified portfolio of U.S. equities today, you do not own a stake in the American economy. You own a digital derivative of a simulation that is being sustained by a dwindling supply of genuine liquidity. The incident on October 14th was a dry run, a fracture in the glass that precedes the total shatter. By the time the masses realize the exit door is locked, the algorithms will have already evacuated. This is not a prediction. This is the structural reality of the 90% ghost market.
The visible story.
The official narrative is a masterpiece of psychological engineering. It is a story of resilience, innovation, and the great decoupling. According to the financial press and the White House economic briefings, the U.S. equity market is currently in the midst of a structural renaissance driven by artificial intelligence. The narrative is simple. We have conquered inflation without a recession, and the Magnificent Seven, now being rebranded as the AI sovereigns, are the engines of a new global epoch. Mainstream analysts point to the 401k balances of Middle America as proof of success. Look at the numbers, they say, the math doesn't lie. They cite the wealth effect, the idea that rising asset prices lead to increased consumer spending, which in turn justifies the higher asset prices. It is a perpetual motion machine that the media presents as the ultimate triumph of modern monetary theory. Consider the headlines from mid-2025. The Wall Street Journal ran a lead story titled, "The New Inevitability: Why the Dow 50,000 is Closer Than You Think." Bloomberg followed with an analysis piece claiming that inelastic demand for tech sovereignty has rendered traditional valuation metrics like P/E ratios obsolete. They tell you that this time is different because the efficiency of the market has been perfected by technology. This visible story serves a specific function. It creates exit liquidity. To keep a ghost market from collapsing, the system requires a constant influx of passive capital. Your monthly pension contributions, your automated index fund purchases, your recurring deposits into ETFs. The mainstream media acts as the marketing arm of the clearinghouses, ensuring that the buy the dip mentality is hard-coded into the public consciousness. They talk about the AI productivity miracle as if it were a tangible physical resource, like oil or gold. They ignore the fact that 82% of the S&P 500's growth in the last 18 months can be traced back to just 5 ticker symbols, and that those ticker symbols are sustained by a complex web of share buybacks and interinstitutional swaps. The visible story tells you that the market is a voting machine, where every participant has a say. It tells you that if a company performs well, its stock goes up. It tells you that the invisible hand of Adam Smith is now a digital hand, but it is still working for you. So we are here to dismantle that illusion. We are here to show you what's actually happening behind the tape. Because while you are being told a story of growth, the internal architecture of the market is being hollowed out. The visible story is the anesthetic. The hidden mechanism is the surgery. And the patient is not expected to survive the procedure.
The hidden mechanism.
To understand why the market is a ghost, you must understand the physics of the synthetic index. We have moved past the era of human traders. We have even moved past the era of simple automated bots. We are now governed by a closed-loop system of internalization and passive inelasticity. The market today is dominated by three primary forces: BlackRock's Aladdin, Vanguard's V-Corp, and the high-frequency liquidity providers, HFLPs, like Citadel and Virtu. These entities do not operate in competition. They operate in a state of algorithmic symbiosis. 1. The Aladdin overlay and price inelasticity. BlackRock's Aladdin, short for Asset, Liability, Debt, and Derivative Investment Network, now oversees more than $21 trillion in assets. But its influence is far greater than its AUM, assets under management. Aladdin is the operating system for nearly every major central bank, sovereign wealth fund, and insurance giant. Aladdin's primary goal is risk parity and stability. It achieves this through a mechanism called algorithmic smoothing. When volatility enters the system, Aladdin's risk models trigger offsetting swaps across thousands of portfolios simultaneously. This creates the illusion of a soft landing because the price action is being artificially dampened. But there is a cost. This smoothing has created inelasticity. In a healthy market, if there are more sellers than buyers, the price drops until a buyer is found. In the ghost market, Aladdin and its counterparts have removed the sellers. Through the massive expansion of passive indexing, ETFs, 90% of all shares are now held in perpetuity by algorithms that are programmed to never sell unless a specific, catastrophic threshold is met. This means that the remaining 10% of active volume now dictates 100% of the price. If a single large seller enters the market, there is no natural buyer on the other side. There is only the algorithm. 2. The internalization trap. This brings us to the second hidden mechanism, internalization. When you place a trade on a retail platform, that trade almost never reaches the New York Stock Exchange. It is internalized by a market maker like Citadel Securities. Market makers use a technique called wholesaling. They pay for your order flow, PFOF, so they can see your intent before it becomes action. They then use synthetic liquidity to fill your order. They aren't selling you a share of Apple, they are selling you a promise of a share of Apple, which they then hedge in a dark pool using high-frequency algorithms. This creates a mirror market. 94% of the daily volume we see on the tape is actually just these market makers trading with themselves to rebalance their books and harvest the spread. It is a zero-sum game played at the speed of light. Because these trades happen off exchange, they do not contribute to true price discovery. They only contribute to price maintenance. 3. The buyback feedback loop. The third pillar of the ghost market is the corporate buyback loop. Since 2010, U.S. corporations have spent over $9 trillion buying back their own shares. Where does this money come from? It is not from profits. It is from the debt equity swap. Companies issue low-interest corporate bonds, debt, and use the proceeds to buy back their own stock. This reduces the number of shares outstanding, which automatically increases earnings per share, EPS, even if the company's actual revenue is flat or declining. The algorithms are programmed to trigger buy orders whenever a company announces a buyback program. When this creates a synthetic floor. Even if the underlying business is failing, the stock price continues to rise because the company is cannibalizing its own balance sheet to feed the algorithm. This is the $100 trillion simulation. The market is no longer a tool for capital allocation. It is a mechanism for the refinancing of reality. You are trading against a mirror. You are buying digital dust in a system where the house, the market maker, and the game, the algorithm, are the same entity. The physics of this system are inherently fragile. Because there is no organic liquidity, the entire structure relies on the consensus of the algos. As long as Aladdin, V-Corp, and Genesis 6 agree that the price is up, the price is up. But if even one of these frameworks detects a liquidity desynchronization, like the one on October 14th, the feedback loop reverses. The ghost market will not collapse with a whimper. It will vanish in a flash freeze, because when 90% of the market is holding for the long term in passive ETFs and the remaining 10% of liquidity is synthetic, the moment the bid is pulled, the price doesn't go down, it goes to zero. The architects of this simulation are not blind to its fragility. They are fully aware that the ghost market is a radioactive asset, but they cannot allow it to fail. To do so would mean the end of the US dollar's hegemony and the total vaporization of the global pension system. Therefore, the system has developed a series of countermeasures, emergency patches designed to prevent the flash freeze. 1. The plunge protection upgrade. Historically, we knew this as the Working Group on Financial Markets, established after the 1987 crash. But in the age of algorithms, the plunge protection team has gone digital. They no longer call major banks to buy the dip. They have integrated directly into the plumbing of the clearinghouses. Under the guise of market stability mandates, the SEC and the Fed have quietly authorized synthetic liquidity provisions. When the algorithms detect a bidless vacuum, the Fed's Standing Repo Facility, SRF, acts as a Borg for the market makers. It provides near infinite overnight liquidity to the HFTs, allowing them to maintain the synthetic bid even when there are no real buyers. This is the ultimate moral hazard. The system is essentially subsidizing the fraud. They are providing the fuel to keep the buyback loop spinning, even as the gears are grinding into dust. 2. The 1987 versus 2026 comparison. To understand why the current exit strategy is different, we must look at the historical anchors. In October 1987, the market crashed because of portfolio insurance, a primitive version of today's algorithms. When the market started to drop, the insurance models forced everyone to sell at the same time. The human factor was still present, and humans eventually stepped in to stop the bleeding. In 2026, the human factor has been purged. There is no one to step in. The exit strategy for the system today is not to save the market, but to hibernate it. This is the flash freeze protocol. If the algorithms detect a total loss of price discovery, the exchanges will not just halt for 15 minutes. They will implement a regulated settlement period. They will effectively turn off the tape for days or weeks, allowing the central banks to manually revalue the assets on the ghost ledger. This is what we call the accounting reset. They will change the rules of the game mid-match to ensure the house doesn't lose. 3. The SEC's transparency Trojan horse noticed the recent push for enhanced transparency and real-time settlement, T+0. The mainstream media presents this as a win for retail investors. It is actually the opposite. T+0 settlement removes the cushion of time. In a T+2 world, there's a 48-hour window to find liquidity. In a T+0 world, if the algorithm fails, the margin call is instantaneous and absolute. This efficiency is actually a liquidity trap. It ensures that when the flash freeze happens, no one, not even the biggest hedge funds, can move their capital out in time. The system's solution is to create a total information environment where every dollar is tracked and every trade is pre-cleared. This is the precursor to the central bank digital currency, CBDC integration. The ghost market is being used as the stress test for a fully controlled, fully synthetic economy. They are not patching the cracks to save you. They are patching the cracks to ensure that when the dam breaks, the water flows exactly where they want it, into the private ledgers of the mega institutions, while the public ledgers of the 401s are left dry. This is why this time is different. In 2008, they bailed out the banks. In 2026, they are bailing out the simulation itself. The exit strategy is no longer liquidity, it is tokenization. They will turn your ghost shares into utility tokens that can only be spent within a regulated ecosystem. The market isn't going to crash in the traditional sense. It is going to be enclosed. We are approaching the synchronicity threshold. The ghost market can only exist as long as the algorithmic consensus remains unbroken. But as of Q3 2025, we have observed a growing divergence in the internal data. The lead algos are starting to hedge against their own synthetic bids. the timeline of failure. The breaking point will not be triggered by a war or a traditional economic data point like unemployment. It will be triggered by a collateral mismatch. Phase 1, the liquidity drift, months 1 to 3. You will see a sideways market with record low volatility, but internal spreads will widen. Retail traders will find that their limit orders are taking longer to fill, and slippage will become common. This is the algorithms quietly withdrawing real liquidity and replacing it with placeholder debt. Phase 2, the flash freeze, the 120-second window. A minor event, perhaps a mid-sized insurance company failing to meet a margin call, will cause a bidless vacuum in a specific sector, like small-cap tech. The HFTs will instantly pull their quotes. The tape will go blank. For 120 seconds, there will be no price for the S&P 500. Phase 3, the enclosure, post-freeze. The regulated settlement period begins. The system freezes all transfers. Smart money will have already moved their assets into non-custodial or physical structures. The masses will be left holding synthetic dust that is waiting to be tokenized by the Fed. Analytical positioning. How the smart money escapes. This is not financial advice. This is a risk memo on how institutional family offices are currently positioning to survive the enclosure. 1. Moving beyond the index trap. The smart money is abandoning the passive index, ETFs. Why? Because an ETF is a digital wrapper around the simulation. If the simulation freezes, the wrapper is worthless. They are moving into direct ownership of productive hard assets, land, energy infrastructure, and mid-tier companies that operate outside of the Magnificent Seven algorithmic loop. They want assets that have a physical yield, not a digital capital gain. 2. The short volatility, a decay strategy. Institutions are using tail risk swaps. They are essentially buying insurance on the simulation. They aren't shorting the market in the traditional sense. They are shorting the consensus. They are betting that the algorithmic smoothing will fail. When the flash freeze happens, these swaps will pay out at a ratio of 1,000 to 1 because they are priced based on historical volatility, not systemic fragility. 3. Asymmetric liquidity. Anchors, they are holding hard money outside of the banking system. This is not just gold and silver. This is private credit, secured by real-world collateral. They are becoming the lenders of last resort for a post-market world. When the ghost market vanishes, real debt, backed by things like grain, oil, and timber, will be the only currency that matters. The goal is not to beat the market. You cannot beat a simulation that the house controls. The goal is to exit the simulation. To do that, you must recognize that liquidity is an illusion. In a crisis, the only things that are liquid are the things you can touch, and the things that the system cannot turn off with a line of code. Smart money is currently de-risking from any asset that requires a centralized clearinghouse. They are moving towards sovereign custody. They are preparing for a world where the stock market is replaced by a state-managed utility. The ghost market is the final stage of a terminal financial system. It is the result of 4 structural truths that no rate cut or stimulus package can fix. Truth 1. Price discovery is dead. The market is no longer a signal, it is a simulation managed by 3 primary algorithmic frameworks. Truth 2. 94% of market volume is synthetic. You are trading against a mirror market designed to harvest your capital as exit liquidity for the architects. Truth 3. The flash freeze is inevitable. Because there is no organic bid, the moment the algorithmic consensus breaks, liquidity will vanish in 120 seconds. Truth 4. The system is not trying to save you. Their exit strategy is the enclosure, the transition from a free market to a tokenized state-managed ecosystem via CBDCs. You have been conditioned to believe that the market is the economy. It is not. The market is a risk management layer for the elite, and you are the buffer. When the ghost finally leaves the machine, the only thing left will be the physical reality you ignored. The math for every dollar in existence has changed. The synthetic index is a trap, and in a simulation, the only winning move is to stop playing the game before the power is cut. Bidless market detected. System status critical. Prepare for enclosure.